Alrighty, folks, I am starting to see a lot of real estate professionals declare and post their thoughts about interest rates a la 2025. And near as I can tell, everyone in the real estate industry is calling for rates to be significantly lower than I believe they will be. I have seen many folks talk about interest rates being below 5%. Now, of course, I am referring to the 30-year mortgage, owner occ, best credit, all of that. Folks, I don't think we're going to get it. In fact, folks, I think that would be a horrible outcome for the residential market. We're going to have this conversation with Jonathan Twomley, who plays in an entirely different asset class than me. But we're going to talk about 2025 rates, what his community is talking about, and see if he agrees with me. Rates are not going as low as people think. Jonathan, welcome to the show.
Good to see you, Michael, as always.
Absolutely. So you play in the commercial real estate market. We're talking the big stuff. Frankly, a market that has already seen some pretty significant declines of 20 to 30%. We are seeing some Class A properties start to retrade, but not so much in Class B and C. I'm curious, in your world, are you starting to see people talk about, hey, the Fed's going to cut 200 basis points, rates are going to go to 4%, the party's back on? Are you hearing things like that?
Well, I mean, I think people are there's a lot of excitement about rates going down, continuing to go down through next year. And I think lots of people assume that that means that mortgage rates and cap rates will follow.
Right.
Uh, I think there will be probably some correlation, but the thing that people need to understand is that the correlation is not direct, and it's also there's a lag, right? So what even with interest rates going down, there's still a lot of sort of latent distress in the market. And I've been saying this for a long time that if you bought at the top and you overpaid and you're over leveraged, the interest rate cuts are not going to save you.
No.
There may be some people who are really on the margin where this will make a difference, but if you bought at, where an interest rate of under 4%, and now even with your rate cap, you're up at 6, you go down to 5.5, you're still screwed, right? And it's probably not going to come down to 5.5 quickly just because of this rate cut. So, what we saw in the great financial crisis as well was even when the Fed cut rates dramatically, interest rates didn't follow to the same extent. I mean, they did go down, but they were, they were in the high fours in 2012, 2020, 2013. Even though the Fed rate was substantially lower, right? The interest rates didn't go because the spreads were still high. The spreads were in excess of 200 basis points, and cap rates took a long time to follow as well. Cap rates remained elevated because people were, investor sentiment was still bad. So, when you talk about what goes into, there's a whole mixture of things that go into the mortgage rate, including the spread, which is based on the bank's perception of risk, and then you take the mortgage rate, and there are a lot of other elements that go into the cap rate, namely investor demand and investor risk perceptions. And until those change, you're going to continue to see, I think, elevated cap rates. The raising capital, I mean, everybody that I talk to right now, raising capital is very hard. LP investors are all feeling shell shocked, and if that's the only way to solve that problem is to start raising what you offer to investors to get them to open their wallets. And if you do that, the cap rates have to be higher. You can't be paying a really low cap rate and then offering your investors a really high return. The math just doesn't work. So I think this is exactly what happened the last time around. Investors started expecting 20% cash on cash returns to open their wallets, and they just weren't interested in kind of low teens returns. Even though typically those are pretty good returns, they said you got to show me more. So I expect to see a repeat of that.
Yeah, I think what a lot of folks in the real estate industry, right, whether they be investors, GP/LPs, single family real estate agents, mortgage brokers, they've been in a depression for a couple
Yeah.
of years now, right? Mortgage brokers, depending on who you talk to, 50 to 60% of the folks are out of the business. Real estate agents are losing hundreds of thousands of licensed agents monthly, it seems. Uh, and I think what a lot of those folks are feeling is just almost desperation,
Yeah.
right? They're almost desperately wanting the Fed to cut, and they are unnaturally creating, a 50 basis point cut with a 50, basis point reduction in mortgage rates. And I just want to be clear, when I look out into 2025, the big difference structurally is we are going to go from a multi-year yield inversion where the long end was lower than the front end to an environment where we have pretty significant steepening. I expect the short end to react quickly and almost violently to Fed rate cuts of 200 basis points, but I don't expect the long end to move much. And it is possible it goes up from here. And if the long end, meaning the long end, generally speaking, 5, 10, 20, 30 years, doesn't move down or slightly ticks up, you're not going to get any interest rate love, any
Yeah.
interest rate love. And I think that's going to shock a lot of people. And more importantly, the reason I brought this up is I think there are a lot of people building 2025 plans around a 30-year mortgage with a 4 handle. I think that is a gigantic mistake. All right. You got to remember, yield inversion, steepening. The behavior of the mortgage rates is going to be violently different.
Yeah, I don't disagree with that. And I think it's going to be similar in the commercial space as well. I think you're just going to continue to see, maybe there'll be a little bit of rate relief, but I don't see there being a dramatic amount of rate relief.
Yeah, that's exactly
because again,
right.
you're basing your mortgage rates on the 10-year treasury, the 5 or the 10-year treasury, right?
Correct.
And so, I just don't see a dramatic decrease in that, in those rates coming anytime soon. Like I said, some decrease. I don't think it's going to be zero, but I
Right.
don't think it's going to. I don't think it's going. Listen, let's put it this way: we're not going to. If you're expecting sub 4 interest rates because you need them to save your deal, you're not going to get it. Like
No.
you're never going to get it, absent another worldwide pandemic. But even that, my view on that is we're not going to have the shutdowns that we saw
Yeah,
before, right?
I don't think so.
It'll be managed very differently if we see that again. So, great financial crisis, like crisis, pandemic, that's what you need to get those zero rates again and have that kind of compression. And plus, it has to come. The other thing too that people don't like, I think a piece of information that's missing from everyone's analysis is that those zero rates, right, came at the end of a very long real estate cycle, right? So there
Yeah.
had been so much momentum that had built up over the years that the FOMO was just building and building and building and building. And then when the rates dropped to zero, it just set the whole thing on fire, right?
Yeah.
Even if the rates were to drop back to zero right now, we're in a different part of the cycle psychologically. This is just what I was talking about a moment ago. Like, it is just not, we're at the bottom of the cycle now. We're not going to jump to the top of the cycle in 6 months, right?
No.
It just doesn't work that way, right? All
No.
the liquidity
Totally
has
agree.
to return to the market, and we're talking about equity liquidity, right? Not even debt, but debt liquidity. Frankly, if the banks are still having problems with their balance sheets, you're just not going to see this change all that much, right?
Yeah.
So, and the equity investors are also going to have to recover. We're going to have to find like a new generation of equity investors who were not burned at the top of the market, right? And if you think about, I'm talking about commercial here, obviously. If you think about like the volume of transactions that happened in 2022, like the number of people, just the sheer number of LP investors who were involved in deals at the top of the market, right? I mean, I just don't think that we've even seen this before, where the top of the market coincided with the absolute, like historic levels of volume, right?
Yeah. No,
And
we
then
haven't.
it just crashed overnight because of interest rate hikes. Like, we haven't seen anything like this before. So like, so many more people were involved in deals than ever before, and then all those people got hurt, and that is going to have a long time lag effect on the market. And
Yeah.
raising capital is going to be tough for a while, and people just have to. Interest rates are not going to solve this problem. You and I have both been saying this for a long time, but it's just not. It's not
No.
a panacea. It's not a panacea.
Yeah. One of the things I know about the end of the cycle is you got to get through it.
Yeah.
And, said more bluntly, we haven't had enough pain,
Yeah.
right? There's been threats of pain. There's been extended pretend delaying pain, but the end of the cycles are painful. right? We have to have a cleansing of the system. And let's be clear, we've been talking about it for a couple of years about this coming to commercial, but it's going to come to residential as well, right? I think there were a lot of people that chased Airbnb and all of these things and beach, in markets, and travel is not the same as 2 years ago. And if you built a business on a shaky debt foundation, even in residential, you could be in trouble, right? If you overpaid for something in Palm Springs, you overpaid for something,
Yeah,
right? Palm
yeah,
Springs
totally.
has adopted, pretty aggressive short-term rentals, and you've lost some money. And I think again, I just want people to realize we're not going, in my opinion, sub 5% in 30-year mortgage rates in 2025. And if you're building business case on that, I think you're going to hurt yourself. And if you're counting on sub 5% interest rates to bail out your bad decision and you just want to, you hold on tight, that's not a great answer either. Because guys, I remember a guy in 2006. He was worth 10, 12 million bucks. He was flipping $2 or $3 million flips a year in the Bay Area. Even back then, this is like, God, 06, 07, something like that. They were $1 million flips. And I remember having a conversation with them over I don't know, call it a late lunch. And he was pontificating taking his first loss. He was talking about it. He has this offer. He could let it go, but he's going to have to absorb a $50,000 loss. And some of it was ego. Some of it was, I don't know, belief that it will turn around. And he didn't take it. That one decision took out his entire portfolio, got divorced, got bankrupt, out of the industry. Sometimes you've got to clean up what you have and stop hoping for some, white knight 12 months from now, because that could ruin everything.
Why did he
You know,
lose more? He just held on to it and it just kept
yeah,
sinking. Is that what happened?
he held
Yeah.
on to it. That made his credit go down, and then that hurt other projects, and then he didn't have liquidity, and he lost every property. Everything went to foreclosure. Never sold another property other than foreclosures, and he was wiped out because of that one
Wow.
decision.
Well, listen, this recency bias is a real problem for investors, right? And recency bias, if you don't know what it is, it's the idea that you believe everything is going to, whatever is most recent and most dramatic, you believe is going to continue, right? And so people, because people who got really uh, like did really well at the top of the bubble think that's going to continue, or it's going to go right back to it, or people who need things to be fixed because will also assume it's going to go right back to the way it was, right? And this can work in negative too. Like after a couple of years of when the pain really hits in real estate, then there will be people who think that's going to last forever, right?
Yeah.
Because it's recent and it's dramatic. But I saw this happen as well when right after the crash. I remember my wife and I went um, up to Lake George, and we were staying in this like very nice bed and breakfast. And I was talking with the owner, and the owner had been a subprime mortgage originator, right? And he was talking, and I remember talking with him about it, and I was still a lawyer at the time. And we just had the crash, right? The crash had just started, and all the subprime was getting wiped out. And he was talking about how he can't wait to get back into the business. Like he's just going to do it again, right? Because he'd done so well at the top of the market, and he just sort of assumed it's all going to just go right back there again, right? And if he'd made that bet, I have no idea what happened to him, but he was betting on things coming back, I mean,
Yeah, he lost.
he lost. He was never right on that one. And just another example of this, I'm looking at a hotel right now here in Brooklyn where the brand that had owned this hotel, basically COVID was their business model. They got a whole bunch of VC money, I'm assuming, during COVID because they opened a whole bunch of hotels in very short order. Like, and we're talking big deal, like big hotels, $100 million hotels. But their whole business model was, oh well, people are going to like be in isolation or whatever, like forever, right?
Hmm.
And they convinced some VCs to give them a ton of money to start this hotel brand, and basically were belly up within a couple of years because they were basically betting on the top of the market to go up more. And it's just not the way it works. And we're in for a period of pain. The pain is not, like you said, they've kicked the can down the road. This is exactly what happened in the last time around. It took, people, the multifamily market bottomed out in about 2012, 2013, right? We'd been in recovery for how many, 3-4 years at that point, right?
Yeah, at least. Yeah.
Interest rates had gone to zero in what, 2008, 2009?
2008
right?
and 9. Yeah. Yep.
So how long did it take for the commercial market to bottom out after that happened?
4 years,
Because everything
4 or 5
everything
years.
got everything got kicked down the road. So
Yeah, and you're so right. Because again, what I've told people, it was even in my book, One Rental at a Time, is the commercial market and the single family market are not the same thing, right? You call it real estate, but I firmly believe they run in different cycles. And, in the book, I highlight how I jumped from a peak in residential to a bottom in commercial. Dude, I plan to do it again. Right. I think there's a very good chance that we might see a artificial bump in residential real estate next year or the year after if the government gets involved with more free money, right? First time home buyer, all of that. If that happens, we'll get an artificial bump in single family and I'll exit. Right. One rental at a time will be gone. If we get $10,000, $15,000, $20,000 in free down payment money, I will let that run for 9 to 18 months. I'll get another 15, 20% artificial fake appreciation in all my entry level housing. And then I will sell at the peak and I'll bounce to commercial, which I think is going to be, at least in B and C, pressed. So I look forward to that opportunity.
Yeah, I think you're onto something there. Absolutely.
So folks, at the end of the day, when you are making plans, if you're in real estate and you are making plans for 2025, and this real estate agents, mortgage brokers, investors, I strongly suggest you build a business model with 6% interest rates. Earlier, I talked about interest rates not going down. We talked about yield steepening. Like Jonathan, I think we'll see a little bit. To put some numbers on it, we're currently about 6.2, maybe 6.15 on the 30-year mortgage. I could see them going as low as 5.8, but that's it. People building business models with a 4 handle for 30-year money, I believe, are misguided. Jonathan, if somebody wanted to reach out, follow you, see what's going on with the big boys, how do they do that?
Yeah, well, come, follow me on LinkedIn or reach out and send me a LinkedIn request. You can also go to my school group, which is school.com/AIC, and join my group for mentoring there if you want to learn how to do these deals. Those are the best ways to get in touch.
Awesome, Jonathan. Thank you very much for doing this. Have a wonderful day.
Yep, you too, Michael.